These days, everywhere you look in the media, it seems like all the news is bad. It is either war in Ukraine or the various economies across the globe are falling apart or some other bad news. The word recession is being utilized more frequently in the media as more and more pundits believe we are headed towards or already in a recession. A search on Google Trends for recession has increased significantly since 2021. There's so much noise in the market now, and so we wanted to take a step back and walk through the definition of recession and what it really means. Today is recession defined. Before we begin, please like this video and hit the subscribe button with notifications turned on so you'll be the first to know about new content. Our mission at the Personal Finance and Investing channel is to empower people to achieve financial independence. Subscribing will help us achieve that goal. Now, let's get back to today's video. So the question on the table are, what exactly is a recession and are we in one? Let's start high level and get into more details in a bit. Broadly speaking, a recession is a significant decline in economic activity that lasts for months or years. This is only somewhat helpful because there are a lot of ways to measure economic activity, such as gross domestic product, retail sales, unemployment rate, income levels, etc. In 1974, economist Julian Shiskin came up with a definition that has been used since then: 2 consecutive quarters of declining gross domestic product, or GDP. GDP is the measure of the total monetary or market value of all finished goods and services produced within a country's borders in a specific time period. This is a broad measure of overall domestic production and is thus an overall scorecard of a country's economic health. So per the historical definition of a recession, this would mean that a recession would be called if the most recent quarter's GDP was lower than the previous quarter, which was itself lower than the quarter before that. For example, if the third quarter, or Q3 of 2023, had a lower GDP than the second quarter, or Q2 of 2023, and Q2 of 23 was lower than Q1 of 23. One thing to note is that by the official definition, we technically wouldn't know if we are in a recession until after the quarter ended, so we'll already be in a recession before we know that we are. By this technical definition, the U.S. entered a recession in the summer of 2022, as there were already 2 consecutive quarters of GDP declines. However, it didn't exactly feel like we were in a recession because the unemployment rate was so low, and typically unemployment rate goes way up during a recession. The National Bureau of Economic Research, or NBER, has proposed a more broad yet less specific alternative definition of a recession. The NBER defines a recession as a significant decline in economic activity that is spread across the economy and lasts more than a few months. By that definition, we likely weren't quite in a recession in the summer of 2022, as things hadn't gotten bad across the broader economy. And yet, a look at more measures of economic data point a darker picture, and most analysts are now forecasting that we will soon be in a recession. Here are a few examples. Second quarter GDP growth was negative 0.6%, which is not good. The Consumer Price Index, or CPI, was up in August at positive 8.3%. This is a measurement of the overall price of a basket of goods over time. In general, this is a broad measure of inflation, or whether things we buy are more expensive or less expensive. In August, as it has been for months this year, inflation has been very high. This is obviously not good. ISM Manufacturing Index, which is a measure of sentiment amongst industrial companies, 52.8. Being above 50 means it is positive, which is good. Industrial production is neutral. Retail sales, neutral. S&P 500 index performance, negative 23% year-to-date. This is bad. A bear market is defined as a decline of 20% from the high, so we are solidly in bear market territory. Unemployment rate, 3.7% for August. This is good. Jobless claims, 193,000 for the week of September 24th. This is also good. Consumer Confidence Survey, 58.2 for August. This is bad. Housing starts and home builders index are down, which is not a great sign. So most of the factors of measuring economic activity are bad. This implies that even with the very definition of recession, there are significant indicators that are not great, which points to the U.S. economy being either in a recession or headed there shortly. So how are things for the rest of the world? Honestly, things are worse almost everywhere else. Eurozone inflation is higher than U.S. inflation, largely driven by energy prices, which were up 40% versus last year in September. The war in Ukraine and low supply relative to demand have pushed energy prices in Europe extraordinarily higher. Second, the US dollar has strengthened significantly relative to every other currency on the planet and is at an unprecedented 20-year high. The reason is that investors see the US as the strongest horse in the stable, and the dollar is the strongest currency to park their money in. At a glance, this would seem to be a really good thing for the US for our currency to be strong. This is sort of true in that if an American went to Europe on vacation, their dollars would go farther today than it would before the run on the dollar. However, there is another side to this coin, which is that every other country is weaker, which makes the overall global economy weaker. Furthermore, as other currencies weaken relative to the dollar, this hurts the international divisions of US companies who have to convert their sales into US dollars for financial reporting, and their number for sales outside the US will be proportionally lower. So the strong dollar is mostly good for the US, but decidedly bad for the rest of the world. The geopolitical situation in most of the rest of the world is extremely challenging as well. The war in Ukraine is very close to our European allies, and unrest in many major areas abounds. And finally, COVID is rearing its ugly head in many other countries. While the news has mostly settled out in the US, infections in Germany are surging, in part due to cold weather and close-packed Oktoberfest celebrations. China maintains their zero COVID policy despite significant pushback, which constantly puts jarring pressure on already stretched supply chains. The question of whether or not we are in a recession now is a bit of a moot point. The semantics of the term only distract from the truth, which is that we are in a very difficult economic time right now. While some indicators are still strong, like unemployment rate and wages, even those are starting to show some cracks, and most other metrics are performing poorly, both here in the US and across the globe. Many analysts are saying that the worst is yet to come. We might see further stock market declines, continued rising inflation, and a reversal in the job market. It does appear indeed that things are not great now and in the near future. In the next video, we'll provide some practical tips about what to do during recession to protect your personal finances. Let us know what you think in the comments section below. Also, let us know if you have specific topics or questions you want us to address in future videos. Don't forget to like this video and subscribe to our channel so we can help achieve our mission of empowering people to achieve financial independence. Thanks for watching, and we'll see you next time.